Welcome to today's Energy Transition Series webinar. Today we are talking about project financing, battery energy storage systems. We'll be comparing the UK market to some of the emerging debt structures we're seeing in continental Europe. We host these Energy Transition Series webinars frequently. You should look out for the next session by following us at our LinkedIn account, which is Evershed Sutherland Energy, for more details on the next session. So today I'd like to introduce myself and then my fellow panelists. So my name's Caroline Clapham. I'm a partner in the corporate M&A team here. I focus heavily on energy storage and have been working in that asset class since 2017, leading on some of the biggest deals in the market. I'm joined by two of my Evershed Sutherland colleagues and also a guest speaker. So today from Eversheds, we have Peter Greenall. He's an energy and infrastructure partner in our London office. Peter advises sponsors and lenders on project financings, portfolio financings, and acquisition financings in the clean energy and infrastructure space. In the past 12 months alone, he has advised on 5 separate battery energy storage systems financings. We also have a new joiner to Evershed Sutherland in Germany, Alexander Wojcik, who has more than 15 years of experience advising on project financing of renewable energy projects, including storage. He advises national and international lenders, alternative debt funds, borrowers, sponsors, IPPs, and asset managers on complex project finance transactions with a focus on energy and infrastructure projects. We also have Niels Jakeman here. He's the head of origination Energy Europe at NordLB, with nearly 2 decades of experience in energy finance and investment across Europe and Asia. Niels is the head of structured finance energy origination for Europe at NordLB, which supports clients with structuring, arranging, and ultimately lending to project finance transactions. The team covers the full breadth of energy transition assets, largely focused on renewables, and more recently BESS, with an annual financing volume of circa 3 billion euros. So I'd like to open up the webinar today and let's go through and talk a little bit about the current state of the BESS financing market. First, let's talk about what's happening in the past year or so in the UK. Peter, can I turn that over to you first?
Yeah, thanks, Caroline. I think holistically, the UK project finance market for BESS is in a really healthy situation. UK clearly, I think, would be fair to say, the leading market for BESS finance. Overall, there's been an evolution in the last 5 or 6 years ago from small-scale BESS projects, which are generally equity financed and sometimes collected and put into portfolio financings, moving towards more larger single-asset project financings of BESS assets, which are in the 300 to 500 megawatt scale. What has catalyzed this development? I think, obviously, first of all, as I say, project sizes have increased. So now with bigger projects, it makes more sense to go through the rigors and complexities of a full project financing. Whereas in the earlier days of smaller assets of sort of 0 to 25 megawatts, it just wasn't worth the effort of project finance. In the last year or so, or last 2 years or so, there has been a bigger increase in contracted revenue sources for these projects through factors such as floor price optimization agreements, tolling agreements, and the capacity market. So these projects have become inherently more bankable from a project finance perspective. Now lenders have more increasing comfort over their revenue streams. Other factors which have seen towards a trend of single asset large scale project financing are obviously the reduction in battery prices, perception that the technology risk is reduced, and just a general lender education of the asset class more generally as they've advised on financing over the last 5 to 7 years or so. The revenue stacking is better understood, and as I say, the revenue streams are seen as inherently more bankable due to the higher levels of contracted revenues, which are certainly now in the regions of sort of 75 to almost 100% contracted revenues on certain projects. There's still continuing to be evolution in the asset class, and most recently we've seen the emergence of announcements on long duration energy storage and the cap and floor regime with certain long duration BESS assets along with other storage asset classes. So overall, over the past 5 to 7 years, the market has evolved from small scale multi-asset equity financings now towards larger project financings of single assets. But that's not to say that there aren't significant challenges in the UK BESS market, which we can discuss later on the call.
Great. Thank you, Peter. Alex, do you want to touch on some of the key trends in the German market?
So sorry. Yeah, I think it's billed as the next big thing, or hyped as such, and I think there's good evidence for that. The pipeline has matured such that you now see projects being now financed, whereas in the past there was a strong appetite more on the equity side. Now we see increasingly these projects having reached a stage where they are bankable. And then the topics that now are heavily discussed in the German market is to what extent merchant structures can or should perhaps be bankable. We see recent deal announcements where there were apparently merchant structures bank financed, but I think the prevalent structure would still be you would see contracted and expect to see contracted revenue. But there's all sorts of in between hybrid situations, and that is to do with what we're seeing is a debt investors' appetite that is sourced from different sources. So you have banks which will be looking more towards contracted revenue, but perhaps private capital, private debt investors who may be more open to different structures depending on the credit enhancements offered surrounding that relevant or that specific project. And then there's some other special cases, grid deposit financings, which also are being financed in this context, which also ties into the regulatory uncertainties still impacting this sector in the market, and there is a certain difficulty then in making sure or in assessing and modeling the revenue stack or incoming revenues, looking into the future given certain regulatory challenges. So that I think these are things that may be impacting or may be affecting the assessment whether it truly is the next big market. But I remain optimistic that Germany will live up to that billing.
Thank you both. Niels, can I come to you? I know that Nord's been heavily involved in financing both in UK and Germany and beyond in the continental European market. What's been your sense of how the market's evolved over the last couple of years?
Yeah, thanks, Caroline, and thanks a lot for the opportunity to join your webinar. So, as you mentioned, we've been very active in the BESS space. We've been financing projects since 2021. The first projects we did were actually in the US, and that gave us a good few years where those projects were effectively 15, 20-year availability contracts with utilities. So it's kind of the dream offtake kind of story that you want for any new technology. And with any project finance process, usually you start with try to understand the technology. Does it work? Try to understand construction risk. Does it work? Try to start operating. And the good news is, generally speaking, throughout that journey in the US, that has been, and in fact, our portfolio, that has all been very successful. There has been one particular risk that has panned out in the US and elsewhere, and that has been merchant risk, which, no surprise, is why Peter and Alex have both mentioned it just now. We did not jump in the first wave, shall we say, of the UK financings. If anything, that was this comparison between the two markets of what we had in the US and the UK made us say, hang on, let's wait a minute and pick the right time. But since then, coming back to today, in the last, in Europe, we've now done about 10 gigawatt hours across a number of markets. UK has been the most active. We're extremely bullish on the market, and those older projects have now all recontracted. So they've got the revenue stability that lenders are all looking for. So that's made the UK particularly exciting. So very active there. Germany, to pick up on what Alex has said, so they were earlier highly merchant projects. We stayed away. But since then, we've worked on the 3 out of the 4 standalone BESS that have been tolled. So tolls are coming. This is what unlocks lenders into these markets. We've done the first one in Italy, which has now also got tolls coming, and very, 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 very interesting market. France as well, that was more with an OEM floor contract, which some may be familiar with that particular structure. And then there was one project which we did very recently, early this year, which was a BESS in Poland. that was a fully merchant deal, or at least it was no off taker. But maybe we can come on to later how you can get comfortable with something like that, because it's not just a question of is it bankable or not. It's a question of, are there ways of making a project fly even on a more merchant basis, and maybe something we want to explore a bit further later.
Yes, that would be great. I thought it might be interesting to chat a little bit about the main challenges that we see in financing BESS. You know, the role that I will generally play as a corporate M&A person on a debt financing is more on the diligence side, but I will usually have been involved in putting a project together from the outset. And what I've seen over the years with BESS is that there's still not really a market standard position for a lot of contracts, which means that when you are doing a diligence report to lenders, you're telling them about contracts which don't always look the same as they might for solar PV. And that can take a little bit more time to bring lenders up to speed on different ways of contracting, new entrants to the market, new products for revenue. You know, for example, we spent a lot of time last year bringing lenders up to speed on how the Nifila ISDA product worked. And that, you know, causes timeline issues basically with putting your project together, and also getting lenders comfortable with meeting the requirements of their internal credit committees. Peter, I don't know, what do you think are the main challenges in financing BESS, you know, from your perspective that you've seen?
Thanks, Caroline. Yeah, I mean, certainly from a UK perspective, in the last 12 months or so, there's a couple of things, I think, common themes we're seeing in BESS financing, and the challenges to get these deals through credit and eventually executed. I mean, Gate 2 has been hovering over all of us for quite a while, and the sort of complexity of the rollout and the backwards and forwards from NESO and communication on that front has caused quite a lot of sort of gumming up of approvals on financings on classic PF. It's been hard to get deals executed without a firm Gate 2 offer, and on other sort of more portfolio style deals, we've seen lender concerns around this issue being addressed through having to make reps and warranties as to the status of a Gate 2 offer, or for projects which are part of a portfolio to have to fall out of the financing ring fence if they lose their Gate 2 offer or don't procure one. So certainly Gate 2 and Gate 2 has been an issue. And then as the process becomes clearer and people get more comfortable on the firmness of their connections, I think on the other side, sponsors are getting slightly concerned that there's going to be such a glut of deals that want financing once they've got a secure offer in place, that the UK bank market might not be able to support or back the number of deals that might be out there requiring financing. I think another interesting sort of other key development at the moment, as we've all obviously talked about, revenue certainty and contracted revenues, and in particular, there's been a large amount of excitement on tolling agreements that have come out. But alluding to what you said earlier, Caroline, I think there's certainly currently now there's the perception for UK projects that you can have much more revenue certainty, and lenders are looking for that tolling arrangement. At the same time, I think there's an imbalance between borrowers and sponsors who want tolls and the entities out there who are willing to enter into these agreements. As you say, they're relatively new to market. They're complex contracts. From an bankability perspective, they need counterparties who are often investment grade, and they're time consuming and complex to negotiate, and raising a lot of issues to diligence. And there's always a possibility that a toller can pull out of the process, particularly over a 12-month period. So I think the imbalance between sponsors who want tolling arrangements and those being willing to offer them, plus the complexity of negotiating tolls and the ever increasing perception in the UK market that are essential for bankability, is becoming a bigger issue. Although overall it is a positive development that we have more fixed revenue in the sector. I think the only other points I would make is that generally as well, on other areas of revenues, there was a lot of market saturation on ancillary revenues and things like that. So that's declining as a sort of bankable revenue stream on some levels. But at the moment, I think Gate 2 has been a big issue and continues to be so, but hopefully declining. Whereas now the next one will be finding matching supply and demand of tolling and other supplies of revenue route to market arrangements.
Thanks, Peter. Before we come on to Alex in Germany, I just want to pick up one point and maybe get Neil's view on it. You mentioned that now that Gate 2 is reaching some form of certainty, there is concern amongst asset owners as to whether there's enough capacity in the debt market to bring all those projects financing. Niels, you mentioned that Nord is very bullish on the UK
Yeah.
market. Do you have a sense about, whether there's a mismatch in the number of projects that are going to need financing and the amount of lender appetite out there to finance them?
So I think the cop-out answer is it depends. As long as we can find the right offtake structures, there will be plenty of liquidity to finance them. But if the plan is to finance these projects on a merchant basis, then banks will hit limits. And there are banks that have already hit limits whereby they're saying, look, I've got too much merchant BESS now, I can't take any more.
Yeah.
And so I think that's maybe the simple answer. If we want to have a efficient or a sustainable transition to a sustainable future, to make it a bit cheesy, then we need to attract efficient forms of capital, and that requires securing revenues for a decent proportion to unlock it. So I think there is definitely a way forward to bridge that overall requirement.
Have you heard, Niels, of any discussion in the bank market at the moment that all the work, the financings I've done has involved purely commercial lenders, with the exception of National Wealth Fund? Have you heard any discussions about institutional debt now? Now debt tenors in PF are getting longer, and there's better longer tolls in this range available, and therefore that might align with institutional debt.
Yeah, at this point in time, it feels like the bank debt is still the preferred route. Just flexibility, drawdowns, flexibility repayments, all the the usual story. Also potentially pricing. So I think at the moment it does seem to be primarily bank debt. Where we are seeing more alternative lenders coming in is then in the MES space. So it's not uncommon that we'll have intercreditor discussions, for lenders that coming in above us. Usually we like to ignore them completely and say they're completely outside of our deal, but occasionally we get into those discussions as well. So at the moment, I wouldn't say a large proportion on the senior debt level. No.
Thank you.
Turning to Germany, I mean, my experience working in the German BESS market is that there's been a bit of a mismatch in the law, in regulations, and it fitting energy storage. We had some projects where there was diligence issues around, the law applying to renewables projects, but perhaps not fitting BESS. And that has caused issues with, achieving financing for those projects. How has the market caught up? And Alex, what are the challenges that you're sort of seeing within Germany for debt financing?
Yeah, I think that is to a certain extent still true. There is some regulatory challenges, is what I called it, but yeah, risks that you need to get your head around. There's grid fee uncertainties that you need to find a way to deal with. And of course, the main risk is still, I would say, the grid connection bottleneck issue, where there was simply too many grid connection requests, and then you have these long connection timelines and queues, which create a development risk. So I think these are key challenges that developers face in the German BESS space. And from the bank's perspective, or touching on Niels' last point, I would say it's similar in the German market. You still see senior debt prevalent, and private capital, because I touched on that earlier, is probably more likely to have its appetite for special cases. And in the MES space, yes, that's where they would sit in the capital stack. So that's I think but going back to your question on regulatory issues, I think these are the main concerns: so grid fees and grid connection bottlenecks. There's been some proposal to address this, should come into play towards the end of the year, I believe, and we're hoping that there will be more certainty and a new process as to grid connection, where you'll have a maturity assessment and so have a qualitative evaluation rather than first come, first served basis, which obviously leads to moral hazard issues, where you just sort of apply things to secure things and then you have the same result, or hopefully not, but you may face the same result and impasse or simple stop to development as we experienced in offshore wind in Germany, which is also facing a bit of a standstill situation. So in order to avoid that, I think the regulator is aware of that issue. It ranks very high, I think, on their to-do list. So I would expect that they will be coming back with something that the market will be able to work with by the end of the year. I know that it's right now in the legislative process to address these issues.
Mm-hmm. And Neil, so you've done 3 of the 4 contracted debt financings in Germany. Did you have any particular challenges in the German market versus the UK market?
Yeah, so I think pretty much what Alex just said. So those are indeed the hot topics, right? Grid fees coming in. How do you quantify them? How do you get comfortable with them? Is there enough buffer in your cash flows to deal with downside cases? Luckily, we've had some good news recently that they're going to grandfather existing projects. And so as long as you get your project done within this year or early next year, you're fine. So from grid fees perspective, that's good. But then in terms of flexible grid connection agreements, that sounds pretty scary, right? Someone can just turn you on and off regardless of how they feel on the day. It's not quite so simple. You have to be able to take a view on trying to quantify this. There are ways of trying to quantify it. Rationally, you wouldn't expect BESS to be curtailed at times when it wants to export, right? It's a balancing asset. So theoretically, it should support, and there are ways to try to quantify it. So I suppose that's key. What is very important, looking at the lawyers in the room, is making sure that to the extent that there are potential restrictions that come in, that our toll or our toller is not going to penalize us in a particularly harsh way as a result. So that interconnection between your asset, the market in which your asset plays, and the other stakeholders in the deal is absolutely critical. And then in terms of other challenges, I think Peter's already well covered. Yeah, so gate 2, and we've talked about offtake, right? Getting offtake is absolutely critical. But I think for me, what really unlocks BESS is unlocking hybridization. Because yes, standalone BESS will be a great asset class, and it is a great asset class, and it will continue. But I think where it gets particularly interesting is that renewables won't just be renewables. There are markets now you can't do standalone solar without BESS. You just won't get it financed. You won't get your economics to stack up. And so hybridization, making sure that the regulation is set up to allow you to do that, but also that you have offtake agreements that can cover both, because you don't want a toll competing with a PPA and who gets right of way. It can work, but that's where you tie yourselves in knots. So, for me, what unlocks this is hybridization and hybrid PPAs that bundle this all up and de-risk it. And when you take things like the risks that Alex mentioned, grid fees, these assets are 10, 15, 20 years long. There will be tinkerings. We're seeing imbalance costs hitting certain renewable projects by 3, 4, 5x what we expected them to be. If you've got a BESS alongside, it's a natural hedge. So you see, same with negative prices, same with curtailment. So I think finding ways to be able to hybridize, and the good news is that's happening in multiple markets already. But if we can accelerate that would be key from my perspective.
Yeah, and that's an interesting point, because we've seen people approaching that problem in many different ways, and there's no sort of one agreed right way to address that yet. Do you have a solar and a BESS? Are they together? We've seen some situations where lenders are getting comfortable funding colo projects based solely on the solar, and they almost just disregard the BESS and see it as like a potential upside, but it's irrelevant to banking the deal. You seem to be talking about a situation where you would see it more blended, provided the revenue contracts actually work together properly. I think it's my takeaway.
Absolutely. I mean, I
Yeah.
mentioned at the start, there's a project we did in Poland that was 100% merchant BESS. What I didn't tell you was there was a fully contracted solar next door,
Right.
which was giving us the cash flow stability in one financing, and that's going to be the model for the future.
Yeah, because we were going to ask the provocative question as to whether it's even possible to get merchant BESS debt financing anymore. I think, Peter, you've had conversations with lenders in the UK market. I mean, what's your sense on that?
I'd ultimately have to defer to Neil's here, but my view is that certainly now as lenders become keener and keener and more cognizant that they can get contracted revenue in the UK, that it becomes harder to finance a merchant BESS project, certainly a fully merchant BESS deal, and it's, again, subject to the owner operator and the size of the asset. Certainly, any asset in excess of 100 megawatts, which is majority or fully merchant, is very, very challenging to finance from a PF perspective in the UK, although I'd defer to Niels if he disagrees with me on this stage.
I mean, bankability is a strange term, right? There's a bankability with 1 million of debt, or there's a bankability with 100 million, or 70% gearing, or for 30% gearing. At a certain level of gearing, you can make it work, but it's not an efficient way to make this energy transition progress. I think I saw a figure: we need about 40 billion of BESS over the next couple of years across Europe, and doing that at 30% gearing, 40% gearing probably doesn't feel right. So yeah.
Yeah. And Alex, I think you touched on this at the start. I mean, I think you're saying that merchant BESS in Germany is still possible, but usually it involves some unique financing within the capital structure.
Mhm. Yeah. So I think co-location is exactly something that we see in the German market quite a fair bit. And so I think the structure that Niels just mentioned from the Polish market is also something that we see in the German market replicated, or people trying to replicate that. You see mini-perm structures, which basically you have a very short term tenor. You have very tight financial covenants, which leads to efficiency questions. But yes, at the end, you can say then we have a merchant BESS project. It's for a long term, for a mature market, I would expect that things to move more towards a contracted revenue model. But there will be, I think, always a place for special situations where you have, for example, strong sponsors who will offer backstop solutions, all of these things, or these co-location solutions where you basically tuck in the BESS with a strong revenue or energy generating asset financing. So you have the storage basically as an ancillary appendage, if you will. So these things raise efficiency questions, and I think in the long term, as we sort of try to trace the experiences that the UK has had with this asset and financing this asset, I think that's where we will end up as well. But right now, it's still there's still some wild stuff going on and interesting solutions being explored, and you have to some creative stuff that people get their heads around and find that they are happy to do a deal on.
Thank you. Well, we have only 1 minute left, so I just want to open up the panel in case you want to make any concluding remarks. Anyone on the panel? We're happy? Great. Well, I'll just thank our panelists again for joining. And we look forward to talking with all of you in the future about this exciting asset class.
Likewise, thank you very much.
Thanks so much for having us.
Cheers.
Thank you.
Oh,
Bye.
thanks.